Right now, on Saturday the 8th of August 2026, a firm looking after roughly $1.9 trillion of other people's pensions and savings is holding Dogecoin. Not as a joke. As a line item in a regulated fund. Rowe Price, one of the oldest names in American money management, has launched an actively managed crypto ETF. An ETF, or exchange-traded fund, is simply a basket of assets you can buy through an ordinary share dealing account, and this particular basket includes memecoins sitting alongside Bitcoin and the larger tokens. Think about what that actually means. The same institution that sells cautious retirement products has decided a coin invented as a parody of internet culture belongs in something sold to the public. So what changed, and why this year? The approval came through in mid-June 2026, on the 13th, and the fund went live as an actively managed multi-token vehicle, meaning a human team chooses the weightings rather than mechanically tracking an index. That distinction matters more than it sounds. An index fund would have to justify memecoins on written rules. An active manager can simply argue conviction. Then on the 6th of August, Rowe Price publicly defended the memecoin exposure, describing it as a stress test of blockchain infrastructure. Read that carefully. They are not claiming Dogecoin is undervalued. They are saying the most speculative, highest volume corners of crypto are precisely where you learn how these networks behave under real pressure. The effect is showing up in two very different places. In markets this week, memecoins have drifted back while XRP has held its gains, which tells you institutional money is not indiscriminately lifting everything with a dog on the logo. Meanwhile, the retail side has gone into overdrive, with a wave of promotional articles hunting the next Shiba Inu on the back of this approval. That is the genuine risk here. A trillion-dollar brand can accidentally lend credibility to 100 copycat tokens it has absolutely nothing to do with. Underneath the noise, the plumbing is shifting too. BNY is now targeting the $8.6 trillion transfer agency market by adding blockchain-based ownership records for tokenized funds. Where does this head from here? Watch three things. First, competition. Invesco, managing about $1.5 trillion, has reactivated its spot crypto filings, and once one giant proves memecoin exposure does not trigger regulatory pain, rivals copy the template within months rather than years. Second, the infrastructure story. Roughly $6 trillion of bank deposits are being lined up to move onto a shared blockchain, targeted at the first half of 2027. A tokenized deposit is the same insured pound or dollar at the same bank, it just settles instantly at any hour. Third, weightings. Expect the memecoin allocations to stay deliberately tiny, because the objective is participation and data, not exposure. Here is what to remember. This is not really a story about Dogecoin. It is a story about a $1.9 trillion manager buying an option on a new settlement system, and paying for that option with a rounding error of its portfolio. The memecoins are the cheapest possible ticket into a market being rebuilt around tokenized funds and tokenized deposits. So if you hold one of these ETFs, go and check the actual percentage sitting in speculative tokens before you either panic or celebrate. And if you are tempted by the next Shiba Inu headlines flooding your feed today, remember this. Rowe Price bought a stress test, not a lottery ticket.